Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are going to look at 5 different companies that are in the growth sector. We are going to look at their financials, just give you the overview of these companies. Obviously, if you would like to invest in any of these big companies, you would have to do a little bit more than what I'm going to show you today. But before we look at that, okay, let's talk about just generally what's going on in the market. Okay, so just this week, I'm recording this, it's a Friday morning, so I'm looking at the portfolios. My portfolio, it's been up and down. So when I look at the week, for example, it's been up and down. Right now, I think it's probably the highest it's been for the whole week. Okay, previously it was way more than that. It was almost over 51,000 pounds. Right now is way below that, and a lot of that is because the markets have actually been down a lot. So for example, if you own Apple in your portfolio, you're probably down right now about 9% if you bought it just beginning of the week. I own Microsoft, I'm down 8%. Okay, I own Qualcomm, I'm down almost 7% in this. I own CRM or Salesforce, I'm down 7%. If you own the Amazons, the Tesla is down about 16, almost 17% just this week. And it's tough. Like when you own great companies, we always talk about owning amazing companies, whatever, but this is keeps going. Microsoft, they haven't done anything wrong. Okay, they doing really great in terms of business side of things, but because generally the stock market is going down a lot, it's obviously going down with it. And that kind of got me thinking about generally what the markets are like generally. Okay, so this is to show you the psychology of the market cycle. So what happens? We are human. We have feelings, and when things are doing well, we get excited, very excited, just like 2020 and 2021. Okay, we're very excited about everything that was happening. We were buying the Teladocs, we were buying everything that's in the ARK investment portfolio. We were buying the Teladocs, we were buying Zooms, we were buying Palantir, all of these companies that are down right now 70, 80, 90%. I think it was a couple of days ago, I saw Tattoo Chef, and I remember buying that stock, and I sold it when it was like £21 per share. Straight after I've sold that, it kind of kept going down, and I thought maybe it'll bounce back on someday. I looked at it a couple of days ago, it was only $6 per share. I used to have like $7 or $8 shares, and I sold that very quick, very early. But it's really crazy. It's crazy. I was part of that hype, whatever, but I wasn't actually putting a lot of money. I was putting a little bit of money here and there. But this is what is going on, right? And the reason I also got involved is in this graph. So let's have a look. You start with some sort of a rally. Things are getting better. There's a hope. There's optimism. Everyone believes the stock market is the best thing in the world. It keeps going up. In like 2021, June, July, August, September time, we will go, or 2020, we will going up. There's a thrill, there's a euphoria to the point where everybody is now buying the Teladocs, they're buying the Zooms, they're buying all of these companies that have no earnings yet. There were so many companies out there that have no earnings, but everyone, because of the momentum, because of the euphoria that was going on, everyone was just basically buying, and everyone thought they were genius. Okay, everyone was thinking, okay, I'm gonna make money, I'm gonna be rich or whatever. Then obviously we just get to a complacent situation where we just need to cool off for the next couple of rally, blah blah blah. Then the anxiety hits, some people are thinking, this is actually becoming difficult now. What's going on here? And then it keeps going down, and then you got to the denial situation. My investments are with great companies. They will come back. No worries. Okay. And I think this is where we are now. Okay. I think we're in that situation where we are saying to ourselves, yeah, my investments are absolutely fine with great companies and so on. Okay. But the difference between someone who's saying this and with no strategy and someone who's saying this with his strategy is, with his strategy, you're going to come back up at some point, and this is a buying opportunity for you, and it's really important. It's that simple. You're going to come back at some point, so you look around and say, okay, what can I actually add to my portfolio? What are some of the great investment that I've actually discovered in the last couple of years? I know they're going to be around, whatever they are, you name them, you add it to your watch list, like I've always said, and then you start buying it. But the ones that don't have any, obviously, plan, it gets to this stage where I'm getting 100% out of the market. I can't afford to lose anymore. It's crazy what's going on. People are like, oh my gosh, this is absolutely crazy. I need to get out of the market, and everyone starts selling. And then you get to the anger situation where people are like, oh, why would I ever invest in the stock market? It's the worst thing in the world, blah, 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 blah. And then we get to depression mode, and then the stocks start slightly getting better because obviously, remember, when we were here, we didn't really care. We were buying any company, okay? So obviously, there has to be a cooling off time. And that's what's happening around here. That's why people are, obviously, valuations were very high. Look at Tesla, for example, right? It was in the thousands, PE of thousands. Some of these companies that we were buying didn't even have a PE. They don't even have a positive earnings, right? So the depressions and the display, and then you get to that situation, and then all of a sudden we're going back. Okay, this is Saka's rally, blah, blah, blah. And then people start obviously believing in the stock market. And generally after a while, it will go back, but it will not go back to the highs of the euphorias and all of that stuff. It will go back to where it belongs. Okay, so to like what's called reversion to the mean. That's basically what's going to happen. And it's really important that you understand this. You have a strategy and you stick with your strategy. Yes, you might see Apple going down 7%, 10%, 20%, or Microsoft, or whatever, MasterCards, whatever. Do you have a strategy? What's your plan? Okay, execute that plan and focus on that plan. Right, so let's now get started to the video. I hope that was helpful. It's really important that we talk about that kind of thing because of what's happening right now. I got a lot of friends who are kind of freaking out, and I'm looking around thinking, you know what? Let me have a look around. What can I add to my portfolio? What is down today? Like I get excited. I genuinely wish I had unlimited money because right now I would be buying a lot more stocks, right? But I'm trying to be careful because I don't want to put too much too early, or at the same time, I need to make sure I protect my, obviously, my emergency fund and that kind of thing. So I'm not putting a lot of money, but I'm putting enough for me to actually buy more of the companies that I love. Right, so now we're going to look at 5 different stocks that you could potentially add to your portfolio, but you're going to have to make sure you do a little bit more research than what I'm going to share with you guys here today. So Booking is the world's largest online travel agents. I'm sure you've used it if you have ever traveled. It's one of the great websites. I love it. I use it all the time. I get some sort of like a discount as well here and there. So they are quite good in terms. So they own loads of different actually websites, not only booking.com. So you can check that out if you're interested in this. And let's now look at the fundamentals of this stock. Again, if you are interested, go to their website, look at their 10Ks, look at the last 5, 6, 10 years, into where the company was, what has happened to the company. Has it, right now it seems very expensive, but again, there must be a reason. I don't think they've ever done a split, or they might be doing a split very soon because it's very expensive when you look at that, but you can buy fractional shares anyway. So currently trading over just $2,000 per share, EPS of 12, market cap of $85 billion. I genuinely didn't think it was that big. I was surprised when I found. Economic mode is a narrow capital allocation. The company are doing the management and doing very good, and they're allocating that money. Beta is slightly high. Okay, we're normally looking for anything below 1. And in this current market is really important because the stocks are going down 5%, 7%, whatever. So it's very important to have a lower beta, because lower beta means your stock overall portfolio is not going to fluctuate, like go down 20% every single day or whatever, right? But when there's a rally on the other side, an upside, then you're not going to be obviously making enough as much as the rest of the stocks that have a higher beta, basically. PE seems very high, but price to free cash flow is just about under 20%, which is 20, so which is quite low. Okay, and when it comes to dividend, they don't pay any dividend. They have $4.37 billion of free cash flow. Profit margin just 10%, operating margins of 24, return on equity 21, and revenue. So year on year in terms of the revenue, they've actually grown their revenue about 121. I don't know if that is COVID related or not, but that's possibility because 2020 everything was closed. To 2021 everything was kind of opening up again. So that could be an explanation for it. So you have to be careful when it comes to that. Total returns over the last 10 years, including, obviously, they don't pay any dividend. So about 11.62%, that's percentage, okay? And then current ratio just below, just above 2, which is very good. We're looking for anything above 1, which is quite good. Now, next 5 years, the analysts in Yahoo Finance are expecting this stock to actually grow about 52%. 52% in the next 5 years, each one of the 5 years next. So it explains a lot, because everything was locked away. The world was not open. There's some countries like China and all that are still in that situation. So I'm not surprised at this type of growth. So that's one of the reasons I actually looked at this company, because I thought 52.2% growth in the next 5 years, that's ridiculous. And Simply Wall Street thinks is actually very much undervalued, and they're expecting the price to be $3,554 per share. Morningstar says about 32% discounted. Their target is 3,000, and look at it right now, we're looking about just above 2,000. So it is actually seems very much undervalued at the moment. Tip ranks is 32, again, very similar in fact, but they say in 2,800 is their target, okay? And they are saying is a moderate buy. Honestly, this is a great company. Like normally when we talk about this, like when we talk about companies like high growth companies, we talk about technology companies. So this is one of those companies. It's not technology, but it's actually growing really fast. It seems very much undervalued at the moment. So it might be interested to look at it again if you're interested. The next one is a Broadcom. This is actually a technology company. This is a company that I own in my portfolio. They basically make chips for companies like Apple and Samsung and all of those companies. They have so many different devices that they actually create, and at the same time they're trying to diversify their portfolio away from just phones and so on. So anything to do with Wi-Fi, Bluetooth, whether anything to do with connectivity, they deal with it, okay? Currently trading $571 per share. I wish they did a split, because even though splits do not make any difference, sometimes it's nice to just like if you put 1,000, it gives you more shares, and it kind of feels good in a way. I'll be honest, okay? EPS about 17.55, market cap $233 billion, and economic mode is a narrow, and capital allocation, they are standard. Beta just above 1, so it's not that bad. I'll be honest with you, it's actually, I was surprised it's just above 1. It should be more than that, because it fluctuates like crazy every single day. Just PE about 32. Price to free cash flow is actually below 20, which is quite nice. Dividend yield of, this is the beauty about this company, 2.89%, okay? 5-year growth rate of 43%. Find another company out there that is doing this. This is ridiculous. Dividend growth streak of 11 years, payout ratio of 52%, dividend safety of 67%. That should be high, I'll be honest with you, because look at the free cash flow here, okay? $13.7 billion. Profitability, 27.5%. Profit margin, operating margins 30, almost 35, return on equity 33, revenue growth is about 15.5%, total returns over the last 10 years 35%, which is very, very high. And the debt wise, they have plenty of cash to cover that. Next 5 years, about 15% growth. Simply Wall Street is actually saying is undervalued, almost 40% or 38%. Fair value should be $910. That's very, very generous. Morningstar's fair valued 545, and right now it's about around that area. So I believe Morningstar, but you can average out if you wanted to, because they both use a discounted cash flow model there. And tip rank is just focusing on the next 12 months, and they think it should be $712, and they are saying it's a strong buy. I believe it's a moderate buy, and for me anyway, because I own it, if I buy it more, I think I will averaging it up a lot, because yes, I've got 700 or 41% up on this stock. I wish I bought more. If you look at my old videos, okay, you will see I used to talk about this company a lot, especially when it was undervalued. And luckily I bought it at the time, but I only bought 5. Anyway, let's move on to the next company, and that is EA. This is one of the biggest gaming companies out there. They've been around for a long time. If you were a kid at some point, I'm sure you played their games and so on. currently trading $120 per share, EPS of $2.22, market cap of about $35 billion. I thought it would be bigger than that, to be honest. Economic mode is narrow, when it comes to capital allocation, exemplary, so they must be doing, the management are doing really well with that money and investing it back and so on. Beta below 1, which is really nice. PE 54. I was surprised, but price to free cash flow is about just below 20. So you take whichever you want. Annual dividend yield of 0.61%. 5-year growth rate, I couldn't find it. I think they started recently and they just pay here and there, I guess. Dividend growth streak, just 1 year. Payout ratio, just 10%. Come on, guys, you can increase that, I'm sure. And dividend safety, 80%, and they have $1.6 billion of free cash flow. That's quite low, I'll be honest, but they have enough to pay you that dividend and so on. Profit margin just about 10%, operating margins about 15%, return on equity not that great, but revenue 15% growth in the last year on year. Total returns of last 10 years. So if you had this company in your portfolio, you would have got 22.57% return on your investment. Current ratio 1.2, so it's above 1, which is good. Next 5 years, so every single year in the next 5 years, they're expecting about 16%, 17% growth, just about below 18%. Simply Wall Street says 44% undervalued. The price should be $200 per share. And Morningstar, similar sort of situation, but they are saying it's only $142 per share. Tip rank, let me quickly check how much it was, 120. Okay, so you've got a little bit of upside there, 21%. Tip rank is a 25% upside, and $155 is a strong buy. It's really interesting. It's a company that has been around for a very long time. They are very well established. I don't own any communication services. The only time I actually had any communication services was when I had their competitors, when I had Activision Blizzard. And since they've actually decided to sell the company to Microsoft, I sold that out. So to take some profit off the table. But yeah, great company. It's interesting. I don't think any of their products are going to get stop that anytime soon. People love games. I love games. My son actually plays a lot of their games and stuff. So it's interesting. It's an absolutely interesting company. Right. So the next one, again, communication service company. Their competitor as well, Take-Two, is one of those gaming companies as well. Currently trading $106 per share. EPS 4.5. Market cap only 12 billion, so it's quite small. Economic mode is a narrow, capital allocation exemplary, and they have a low beta, which is nice. PE is all right. Price to free cash flow, I couldn't find it. Free cash flow, in fact, I need to find free cash flow. Let me see if I can find it, because doesn't make any sense. This is interesting. So this is probably the reason why. Okay, so I went to Morningstar and I'm looking at their key ratios. I'm looking free cash flow in 2021 and is minus $18 million. So that's probably explains why I didn't include it here. In fact, I shouldn't have included this, to be honest, because based on that, I don't think it's great investment, because if they're losing cash, that's interesting. Again, you need to look at the business model. You need to look at how long they've been around. Is there a reason why there's a negative free cash flow? Have they actually purchased something? There must be a reason. So you need to dig maybe a little bit deeper to find out. Profit margin about 15%, operating margins of 21%, return on equity 15%, revenue just 4%. The total returns over the last 10 years is 23%, and current ratio just above 1, which is 1 almost 8. And the next 5 years, this is one of the reasons I've included in this. So next basically 5 years, every single year is supposed to be increasing their revenue or their earnings about 13.5%. It's really undervalued according to all of them, and the morning's tip rank actually says a strong buy. Now, I would be careful with this type of business because of the situation that we're in right now. If you had to pick one out of the two, I will definitely go for EA, because they have a little bit of a dividend, and so you get some cash while you wait the stock to bounce back if you're down or whatever, or if we get into a recession. And they also have a free cash flow, so will be interesting. Right, so the next one is Invest Energy. This is one of the companies that have been everyone talks about, basically been talking about since 2020. I've never even looked at it until very, very recent. And they aren't solar. They apparently do some solar panels and things like that, the technology behind it. Okay, they currently trading $140 per share, EPS of 1.16, market cap of 20 billion. Economic mode says none. In terms of capital allocation, they're doing a really good job, and beta is quite high. It is really high because I was looking at their price fluctuation. It's really ridiculous. In fact, let me just have a quick look and show you. Yeah, so looking at this, you can see at some point it was $267 per share. And from there, it's down 47%. So it's one of the companies that have, I think, a lot of the hype people just managed to get hold of. And now it's coming back down to, I guess, where it belongs. I think that's, fair to say. Okay. In terms of PE is quite high. In terms of price to free cash flow, that's a free cash flow, not price to free. They don't pay any dividends, but they do have a little bit of free cash flow. Their profit margin about 11, operating margin about 14.6, return on equity 31, revenue, so growth 75%. This is probably one of the reasons why people were actually on this company. They really loved it, blah, 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 because of that in 2020 to 2021. That's probably why a lot of people were actually buying this company, and that's why there was a massive hype. Now, in the last 10 years, okay, you can look at 32% of total returns and current ratio way above 1, which is really good to see. And this is one of the reasons I've included this. They're expecting almost 11% growth for every single year in the next 5 years. Tip rank says it's just undervalued at the moment, $142 per share. The price is $140 right now, so not much of a room there. And then fairly valued according to Morningstar, and $132 per share. Tip rank is actually a lot more bullish, and they're saying strong buy, and they're expecting the price to be $225 per share. For me, it's a great company, and it seems it is probably in the right industry, but I would really need to do a bit more digging. And right now, this PE seems very, very high to me, 121. So you're going to have to convince me you're actually creating a lot more free cash flow. The revenue is growing. The growth is actually sustainable. All of those things before I can put money into this company. Right. I hope you enjoyed the video. And if you have, I would like you just to give this video a like, subscribe to the channel. Let me know if you have any questions. There's a lot more companies I'm going to talk about in the next couple of days. Because the markets are down so much, I'm definitely going to do a few more videos, because there are companies that we all love that are right now basically trading at discount. So we need to find these bargains before they go away. I hope you enjoy this. Thank you very much. Assalamu Alaikum.